So before I get started, I'm gonna put one person on the spot.
Okay, okay. Hi.
I want you, first of all, Happy New Year. So happy to have you again.
Happy New Year.
You show up to everything I host, and I really appreciate that.
I
Can you
try.
can you tell everybody here why do you show up every single time? Because we talk a lot one on one. Because I've
Uh-huh.
obviously helped you a lot one on one. But why do you keep coming back? Why do you keep joining in on these different sessions? I just want to just share
Yeah.
this little moment.
Okay. So I keep joining your sessions because I tend to learn something new every time, even if it's the same session in a different year. Maybe I missed something the first time or didn't totally understand it, but then the second time I'll get it, you know, more clearly, a clear understanding. So very informative, and I learn a lot. When I first met you, I was just financially illiterate.
Yeah.
So I'm getting some education, and I appreciate it.
So, like I said, get your pen and paper ready. Yes, you'll get a copy of the notes, but just, I want you to really start thinking about how can this stuff apply to you in your current financial situation. Again, for those of you who don't know me, my name is Shantae Moore. I hold many titles. I'm a financial advisor. I own a business called Native American Financial Literacy Services. Have tons of certifications, tons of licenses, but my passion is to teach people how money works. And again, I hold these different webinars throughout the year on just various topics. So also, if you have a webinar suggestion, please let me know, because sometimes I feel like I'm running out of ideas. Please do let me know. I want to give my experience in working with clients one-on-one. This is actually the beginning of my 16th year in the financial services industry. I know I don't look like it in the face, but yes, 16 years. I got my last investment license on Christmas Eve. I'm not Christmas Eve, New Year's Eve in 2005. And that's when I was fully licensed to start my career. Long time ago, back at that time. So as a quick disclaimer, yes, I want to present as much information as I can about IRAs, but there's so many little nuances and little tidbits that I probably won't get a chance to review or discuss. I'm only talking about traditional and Roth IRAs tonight. There are other types. There's SEP IRAs, simple IRAs. I won't be discussing those. Those are for business owners and entrepreneurs. But again, if that's a topic you want to learn about, let me know, because I can definitely do presentations on those, especially if you're an entrepreneur or thinking about going into business for yourself. But one thing you should know is that anything that I share about an IRA, as far as these guidelines, there's a lot of rules and nuances. It's the Internal Revenue Service, IRS, our favorite Uncle Sam that we all have. We all share the same Uncle Sam. They are the ones who determine all the rules. So I'll actually give you a link to their website, and I'll actually pull up their website as I go through a couple of their slides, because that's where you definitely want to check for anything that might change. Because if you're watching this webinar a year from now, things might change, because they tend to change. Our IRS, they change the rules, they change guidelines. But why are we talking about this also? Because I think as the pandemic continues, as COVID remains, and as it affects people's finances, in particular their retirement accounts, I think one thing we've learned the past 2 years, almost 2 years coming up, right, is that when it comes to your finances, the responsibility is really on yourself. It's really on yourself to learn these things. That's why I appreciate all of you for joining, but even folks like Tammy, who's like, I need to come back and learn. I want to learn, I want to become financially literate, because we can't no longer depend on our jobs to do this stuff for us. We can't depend on the government. It's your personal responsibility. So I definitely applaud all of you for joining in today's session to learn again about IRAs and to get that extra knowledge that that I know that you're seeking. When it comes to IRAs are retirement accounts, and retirement, we used to be able to have pensions through our job, and that was it. You used to work like 30 years someplace and they took care of your retirement for you. A lot of folks hope to depend on Social Security, but we know that that's a struggling program in itself. It's underfunded. Will it be there in 20, 30 years. Who knows? We don't really know. So again, your personal savings are what you really should focus on when it comes to retirement. And traditional and Roth IRAs are definitely great tools that you can leverage outside the workplace, not tied to a job. These are things that you can do completely on your own to increase your personal savings. So again, you're taking on that ownership yourself. So as I want to kind of use this slide as a foundation. So, IRAs are investment accounts. And when you really think about where can I save my money? Where can I grow it? Where can, pretty much any place that you have available to, put your money is represented on this slide. Whether it's in a checking account, something at the bank, or maybe your 401k at the job, or maybe you want to establish, a college savings plans or just different accounts. So I typically, when I look at where to save money, I actually start from a tax perspective, because where you put your money, taxes actually do matter. So like I said, we all have our favorite Uncle Sam who pays attention to every single dollar. And you could have your money in a tax now position, which means that as you put money in these places, as you see here on the screen, checking accounts, CDs, brokerage accounts are another investment account. As their money grows, as it earns interest and dividends, you have to pay taxes every single year. That's why it's called a tax now account. Then you have your tax later bucket, which are the accounts listed in the middle. And that's exactly what these accounts do. They grow, they invest, and you pay your taxes later, typically in retirement, when you need your money the most. Now you're also paying out a portion to the IRS. Or you could have a tax advantage way to save your money, where you can grow and invest it without paying taxes. And as long as you follow the rules for those particular accounts, you don't pay taxes at all either when you pull the money out, as long as you follow the rules. So I have a webinar just on explaining all these accounts and about investing. But today we are focusing obviously on the traditional IRA, which is a tax later investment retirement account, and the Roth IRA, which is a tax advantage account. Now I will say this. You should have money in all three buckets. You really should. They all serve their purpose. I won't say one is better than the other. I would just want you to think, even before I really get into the IRAs, I really want you to think, where is my money saved? Is it mostly in a tax later position? Is it mostly in a tax now position? Do you have any money in a tax advantage position? Think about that. Write that down as part of one of your notes, because I encourage you, that's an opportunity to work with someone like myself who could help you leverage all three buckets and have your money in each bucket. But from a tax strategy, we know exactly how much you're paying in taxes, how much you're earning, and how much you actually get to keep in your pocket. That's the ultimate goal, right? We want to keep most of our savings and investments, that money growing hard earned for itself. We really wanted to keep as much of it in our pocket as we can. So when we look at an IRA, by definition, it's an individual retirement account or an annuity that allows you to grow money for retirement. So an individual retirement account, and I'm sorry, these slides are text heavy. It's just no way for me to talk about it. I try to put visuals together. They are text heavy, but again, you'll have copies of all these slides. And I'll probably be reading a lot of the text. I know that's not how you're supposed to do presentations, but I have to for this topic. So an individual retirement account is a trust or custodial account that you set up in the United States for the exclusive benefit of you or your beneficiaries. So again, this is not tied to your job. This is where you go out and establish this account on your own, and it's for the benefit of your retirement. And if there's any money left over when you pass away, you also name beneficiaries, and those monies left over that you haven't taken out will go towards your beneficiaries. Now, an individual retirement annuity actually works the same way. I'm not going to go deep into annuities, but I want you to, as I talk about IRAs, annuities pretty much work very similar as far as the rules, and the rules pretty much are the same. But you can also purchase an annuity contract. Now this is with an insurance company. It's not a life insurance project. product. It's an insurance product, again, called an annuity, where you are the owner of that contract. You would also name beneficiaries for it. And an annuity works really well because it's my version of creating your own pension for yourself. You basically give a lump sum amount of money to an insurance company into an annuity contract. And a lot of the provisions are that they can then take that lump sum and create guaranteed income for the rest of your life for you. So it's like creating your own little pension stream. So again, I'm not going too deep into the annuity itself, but it operates very similar like an IRA. So as I mentioned, you can open this at a financial institution. So you can go to like a Merrill Lynch, the TD Ameritrades, the, Ameriprise Financials, the big investment companies. You can open it with a mutual fund company, even life insurance companies will establish these for you. Or you can open an IRA through your stockbroker. So that would be kind of like people under my realm, like a financial advisor, a stockbroker. We also work with financial institutions, investment institutions to open these accounts for you on your behalf. And as mentioned, any IRA, no matter where you open it with or whom you open it with, they all have to meet the IRS code requirements. So any guidelines, again, all the rules are the same no matter where you go. So keep that in mind. Really, the only difference is what the company invests in that you choose to open an account with. And, if you have an advisor or if they have fees, those are the only differences. Otherwise, the rules are the same. So who can open an IRA? Anyone can open an IRA account as long as they have taxable income. So when I invited you all to this webinar, I said, your working child can even open an account and start investing for their retirement. This is why, as long as any person, it doesn't matter their age, as long as they have taxable income, meaning a paycheck, a W-2 form, a contract, basically anything beyond cash that you're getting paid under the table, as long as you have income that's reported for tax purposes, an individual can open an IRA. So if you have a 16-year-old working teenager, they could technically establish an IRA for themselves and contribute for their own retirement. So it's really cool. This is a long-term investment plan though. It's for retirement. That keyword retirement, later in life. When you retire, the key age is 59 and a half is when that's like the IRS's retirement age. And I'll talk about where does that age actually matter? It actually matters when you start pulling money out. The IRS, they want to incentivize you to open these type of accounts so that you can, again, save money for your own retirement so that you don't have to depend on the government. And so they give you a lot of benefits, which I'm going to talk about, by establishing this account. But it's long term. So if you're thinking, you know what, well, I like the IRA, Shantae, but I want to pull money out in a year from now. Unless you're about to retire, you wouldn't leverage an IRA with the idea of pulling out money anytime soon. Like, you want it to stay there. You want it to invest. And we'll talk about reasons when you can pull money out and exceptions to the rules. Another thing with the IRA is because they give you tax benefits, the traditional IRA as well as the Roth IRA, the IRS limits how much you can put in per year. So whether it's a traditional IRA or a Roth IRA, you can only contribute up to $6,000 per year total into any IRAs combined, cumulative. You can only contribute up to $6,000 per year. And if you're over age 50, you can actually add in an extra $1,000, which means you would have $7,000 total that you can save and invest for your own retirement, again, on your own. And these limits are the same for 2021, and they just came out with the 2022 limits, and they're both the same. So just to kind of give you a quick idea, you could have a traditional IRA and a Roth IRA, and whatever monies you put into each, they both have to equal that $6,000 or $7,000 limit. You don't want to put anything else over the limit because the IRS is going to slap your hand and penalize you for putting in over their contribution limits. Does that make sense? So as you can have 12 IRAs open. Let's say you have an IRA here, an IRA there, over there, over there. It doesn't matter how many IRAs you have. Cumulatively, you can only contribute $6,000 in all of them, in any IRA, traditional, Roth, $6,000 total between those two types. Again, there's other IRAs you could contribute more. We're not talking about those tonight. But does that make sense for everyone? If not, put it in the chat, but I'll try to re-explain it. But I want people to understand that, because I do have clients say, well, can I put $6,000 in traditional IRA and $6,000 in a Roth IRA? No, combine, total, any IRA, $6,000 total. All right, so let's move on. I really just want to talk about what can you put inside your IRA, because this is an investment account. And this webinar is not about investing. I have a whole nother webinar all about investing. If you want the link to that, let me know. I actually might take a moment to find it on YouTube and post it in the chat. But it's an investment account. So when we think about establishing this account, the whole point is to grow money for retirement. So what can you invest inside your IRA? Well, one, you do have the option to invest in nothing and just let it sitting in a cash position. But you wouldn't do that, because it won't earn anything. You can invest in stocks, in bonds, mutual funds, index funds, ETFs, which are exchange traded funds, UITs, which are unit investment trusts. If you got the annuity, there's indexed annuities and variable annuities. These are all different investment tools to grow the money inside the IRA. I'm not focusing on that tonight, again, because that's really the investing part. And that's not, again, I have a whole nother webinar that talks about those things and how they grow. But I just want you to know that you can also invest in real estate. I mean, there's the IRS, they have a pretty long list of things that you can invest in. But the average investor, you'll probably create a portfolio of one or more or a couple of these things. And what makes sense for you? That's when you sit down with a financial professional, and we'll help you figure out what investments to put inside the IRA. Tonight, I just want to teach you how those accounts work and why you might want to use them when you're thinking about investing for retirement. So which IRA do we choose? It really just depends on your needs. It really does. Because when you look at, a traditional IRA, again, it falls in that tax later bucket. I call it tax deferred as well. Or, versus the Roth IRA, which is a tax advantage bucket. There's really three things that I'm going to go through tonight that will help you determine which one should I open. And keep in mind, you probably could open both. It just really depends on your situation. So I'm going to spend the next two slides talking about the pros and cons, or comparing the differences with how much money you could contribute, how does it accumulate, once the money's growing and investing, how does it actually accumulate? And then I think the probably most important features that really have a lot of differences are how you take money out of these accounts. When you're ready to retire, how do we take money out of these accounts? So this is what I'm going to spend the next couple slides talking about. So when we compare contributions between the traditional IRA and the Roth IRA, with the traditional IRA, first of all, the IRS determines by income. They look at your income to say, well, how much, what benefits do we want to give folks who have a lower income versus those who have a higher income when it comes to these IRAs? So with the traditional IRA, there's no limit on your income on what you can earn to contribute to it. So you can open this account, you could be making $1 million a year, and there's no limit on your income to be able to contribute to the traditional IRA. However, on the Roth IRA side, there actually is a limit. Because remember, that Roth IRA, it falls into that tax advantage bucket. There's advantages for having that account open. So with the Roth IRA, the IRS says, well, we know people want to take advantage of those tax advantages, but we're not going to let you just put all your money in there and, pay no taxes. So there is a limit on how much you can earn from an income standpoint and put into the Roth IRA. So with the Roth IRA, and these are the limits here. I copied this from a tax PDF. And actually, I'll share that with you right now, because if you want a copy of this, let me know. This is something that I send to CPAs, tax people. It really just goes through like all the numbers and limits when it comes to taxes. Some people are really nerdy about it. Some people aren't. Some people are like, get this out of my face. But every year the IRS sets guidelines for like, oh, how much can you put in your 401k? How much can you put in your IRAs? And this particular tax sheet goes through any and everything with tax rates, with income limits. So if this is something you want, just let me know. I'd be happy to share that with you. Okay, so we had a question about, does these limits compete with if you have a retirement account at your, pretty much a retirement account at your job? Yes, it does. It does matter. I'm actually going to go through that on the next slide. Another good question, can I get money withheld pre-tax? Pre-tax meaning when you earn your income, like your 401k, when you contribute to your 401k, it goes into it pre-tax. And then whatever's left over, that's what is taxed and gets paid out to your paycheck. So the question is, can I get money withheld pre-tax from my employer and sent to a third-party traditional IRA? Nope. Nope. Remember, IRAs are not attached to the job at all. Not at all. So monies that we'll talk about where the monies can come from also when it goes into the IRAs. But real quick, no. Okay, so we'll talk about that. But what I was seeing on this slide here is that with the Roth IRA, these are the limits. Let me put my phone on mute. These are the limits of what you can earn, the most that you can earn to contribute to the Roth. So for example, if you are a single person, let's say in 2021, and you earned $125,000 to $140,000 in income, this is a period when the IRS says, well, Shantae, you earn too much money. You can't contribute the full $6,000. Now we have a phase out period where the IRS on their website, they will define how much you can actually put in. But it gets to a point when you hit over, let's say when you file your return again, you're single or head of household, when you cross over $140,000 in income, you can't contribute to the Roth at all. So these are the limits. I just wanted to point these out. Again, I'll share links to the IRS website. Like if you want to know, is it the full $6,000? You might not be able to do the $6,000, but they might allow you $2,000, something to that effect. It really just depends because everybody's situation is different. But I did want to just put the basic chart. And they increase. The IRS typically does increase these limits every year. So as you can see for 2022, if you get into that $129,000 to $144,000 range, then you have a couple more $1,000 you can earn before you cannot contribute to a Roth IRA. So when it comes to Roth IRAs, yes, they have a lot of benefits, but if you earn too much money, you probably might not even be able to contribute to it. I just want you to keep that in mind. But as a financial advisor, we got solutions for you elsewhere. A Roth IRA is just something that you wouldn't be able to take advantage of. So I hope that makes sense. With the traditional IRA, IRS doesn't care how much money you make. With the Roth IRAs, they do. They pay attention to your limits, to your income, to determine, if you make too much money, can you even contribute to it? So let's continue talking about contributions. So as I mentioned, as long as you have taxable income, you can open the Roth IRA and contribute to it. Again, with the taxable income. And the first tax benefit that you have with an IRA for the traditional side is that you're actually able to also deduct your contributions when you file your tax returns. And that's another reason why I wanted to talk about this tonight, because we have 4 months before the IRS tax deadline in April. So you're actually able, the IRS says, thank you, Shantae. You're saving for your own retirement. We're going to give you a tax deduction on your income, on your tax return for doing so. And typically there are limits as well for how much you can deduct regarding your contributions. So for example, let's say you make a full year contribution, which is that $6,000 if you're under age 50, $7,000 if you're over age 50. Again, they do look at your income to determine how much of that can you deduct. So for 2021, if you were single or head of household, once you get into that $66,000 income, the IRS says, you can make a full deduction. So I'm actually going to go to their website, and just bear with me because I'm going in and out of the presentation and the website. So anything that I'm talking about, again, I want you to fact check. Go back to the IRS website there. I try to post some of the links in the presentation, but this is where you can determine how much can I actually deduct, based on my income. So right here it says 2020, 2021. And it also matters, which I didn't put on the slide just yet, is if you actually have a retirement plan at the job. So one of the questions was, if I have a job, I have a retirement account at work, can I contribute to this? Yes, but there's limitations on how to do so. So let's say you have an employer, which most people do, and they want to open an IRA to invest for their retirement. So you'll look at this link for 2021, and it says if you are covered by a retirement plan at work, and you are single or head of household, and your income is $66,000 or less, you can deduct the full amount of your contribution. So up to that $6,000, up to that $7,000. If you make between $66,000 and $76,000, there's a partial deduction. If your income's over $76,000, there's no deduction. So I don't go into all these details. I just want to show you where to go to look and check for yourself, because it depends on your filing status and it depends on your income, how much you can actually deduct. So I'm going to post this link in the chat so everyone could click on it real quickly if you want to use it as a point of reference as I go through the presentation. So when it comes to, let me go back to the presentation. So when it comes to the Roth IRA though, there are no deductions. So you get tax benefits elsewhere, but as far as reducing your income, the tax deduction, there are no deductions from contributing to a Roth IRA. So again, if you need that tax deduction, so really the question you should be asking yourself is, am I paying a lot in taxes? How do I want to reduce my taxes on April 15th? Maybe open a traditional IRA and funding it might help you because you'll get that deduction. Now, that's something you also want to sit down and talk to with your tax person to figure out if that makes sense for you. So when it comes to the traditional IRA, again, I took the screenshot from the IRS website. It does matter if you have a job, if you do have a retirement account at work, if you or your spouse has a retirement plan at work, then that will further determine the deduction limit. So I just showed you on the IRS screen if you have a job and you contribute to the IRA. So again, I want to share these links with you so that you can go and check for yourself, because I just don't have the time to go into all the different scenarios and caveats. But does that make sense? So the traditional IRA, you can deduct the $6,000, the $7,000, whatever you contribute, depending on your income. And that makes sense to everyone. Whew, these things can get a little, it's a lot of verbiage, but I want you to know this stuff because it's not easy to go to the IRS website and click around and find this information. We had a question that says, traditional IRA does not mean that contributions are pre-tax. That's correct. They're not. That's not. Pre-tax is only tied to a job. Only earnings, income from a job. That's the only way you have pre-tax anything is from the earnings from an employer. But the earnings grow tax-free until withdrawal. Yes, for the traditional IRA, the money inside the benefit is that the earnings, the growth in it, is tax deferred until later for the traditional IRA. Okay, I don't see any other questions, so let's move along. So when it comes to your 2021 taxes, everyone should know you have until Monday, April 18th, 2022 to file your taxes. What a lot of people don't know, the reason why I'm talking about, deductions and contributions is because when it comes to IRAs, you actually have until the year's following tax deadline to make IRA contributions for the prior year. So if you're learning this tonight and you're like, you know what, I wish I had an IRA. I wish I established a traditional IRA because I really need that tax deduction. You can actually open a traditional IRA and contribute that $6,000, $7,000 or any amount up into those limits. You can contribute those through the tax filing deadline of April 18th. Probably I would do it by that Friday or a couple of days before, and still indicate to the investment company, I'm putting in this money, but I want it to count for 2021 so that I can deduct it on my 2021 taxes. So that's why I'm talking about it tonight. So give you time. So this is something you might want to do, that you want to take advantage of for 2021. Still, you can do that. So even if you had a traditional IRA, or if you had a traditional IRA open last year and maybe you didn't contribute to it, or you didn't max out the 6,000 or 7,000, you can still put money in. When you make a deposit, the financial institution will ask you, is this for 2021 or 2022? You will tell them, no, this is for 2021. Make sure it counts for 2021. So when you file your taxes, you can let your tax preparer know how much you actually did deduct, and they'll calculate on your tax return. And actually, I did want to show you the tax return. I'm not trying to get too far into the weeds in it, but I really want to show you where the deduction actually comes from. So when you file your taxes, you would have to file a 1040 to get the deduction. That's for an individual. This is on your individual tax return. You would complete a Schedule 1, which will outline any additions to your income or adjustments to your income. So I'm going to scroll to the adjustments to income. And here, line item 20. This is where your tax preparer would indicate, oh yeah, Shantae made a $6,000 deduction. So they'll write, $6,000 on this line. And this will actually feed over to your 1040. So on your 1040, when your tax preparer completes this for you, here, so the first part, they indicate what did you earn. We have to disclose our income. If we made money from the stock market, all that stuff, pensions, annuities, IRA distributions, Social Security, all that money that you receive, you have to disclose it. But as you can see, line item number 10, it says adjustments to income from Schedule 1. So this is where that $6,000 deduction would reduce your income. So ultimately, that $6,000 would reduce your taxable income, because your taxable income is then what calculates the tax that you earn on the next page. So this is how you get the deduction. Again, I hope that's helpful. I just, I'm a tax nerd. I'm not a tax person at all. I'm not a tax planner, but I know enough to be dangerous with it. But that's how you get the deduction. So again, if you need that extra, you need to reduce your taxable taxes. That's how you could do it through establishing the traditional IRA. And obviously you're saving for your own retirement anyway. So I hope that makes sense. Again, any questions, please do put them in the chat. I'm going to move on. So that's for the traditional IRA. So I wanted to spend one slide talking about accumulation, because I talked about what you can invest in already inside the IRA. But for accumulation purposes, in either IRA, that money that you put aside, that $6,000, that $7,000, generally you should be investing it. It shouldn't be just sitting in cash. It serves no point in just sitting in cash. Generally, that money is invested in one of those, the stock, the bonds, whatever, that portfolio in the stock market. And that's how your money grows. Because I get some questions sometimes, well, how does it actually grow? By what you choose to invest in. That's how it grows. That's how it actually accumulates. But also, the benefit of putting money in an IRA, whether it's traditional or the Roth, is that your earnings grow tax deferred. So back to the other question earlier from Christopher, the benefit is that you're putting money, you're growing money in the stock market, and you're not paying taxes on that growth. That's a great thing. That allows your money to grow quicker. So if you ever hear that term, my money makes money for me, I want my money to work for me, this is how you do it. Investing it in a tax deferred account, because it's just growing on top of each other. Nothing's coming out for taxes until later, or never if you do the Roth IRA. Another thing is that as it accumulates, your distributions, again, that's when you may or may not pay taxes. And I put distributions are taxed. I should have just said may or may not be taxed, because the traditional IRA, they're taxed. The Roth IRA, they are not taxed. Please let me know if this is too high level, because I'm talking a lot about taxes, there's a lot of big words. I just want to make sure are you guys understanding this? Just let me know, just yes, thumbs up, something. So I want to just make sure it's understandable. Okay, thank you, Christopher. I appreciate it. Try to make it easy. I try to make my best to make it easy. But these words is like distribution, contribution, deferrals. Okay, good. Thank you for the thumbs up, Nakaya and Tammy. Okay, good. Candace, thank you. Okay, good. Everybody's good. All right, good. I feel better because I'm like, whew, I'm sweating over here. I'm trying to explain it easy. But thank you. All right, so now let's talk about taking money out of an IRA. Because that's important, right? Like, you worked hard to save money for your retirement, to be responsible. But now, really, this is probably, taking money out is probably the biggest differences between the traditional IRA or the Roth IRA. So when we take distributions out of an IRA, they're either called distributions or an early or premature withdrawal. So when it comes to the IRA, remember what I said at the beginning, this is long term, this is for retirement. So the IRS really wants to discourage you from taking money out before you actually retire. Remember their age, the IRS says 59 and a half. That's the magic age, 59 and a half years old. Who can figure out that? Just 60 years old, whatever. If you pull money out before you turn 59 and a half, the IRS is going to slap your hand. You're going to get a 10% penalty on whatever money you take out. Unless there's an exception to the rule. And there's always an exception. So I don't want you to think like, oh, my money's locked up. I can't touch it till I get 60 years old. There's ways you can pull it out. But I just want you to know, if you take it out without these exceptions, which I'm going to go over, you will pay a 10% penalty. And same thing with an annuity, works the same way. So let's compare the two. So with the traditional IRA, these are the exceptions. If you want to avoid that 10% penalty, but you're not 59 and a half years old, fine. As long as you pull money out for education expenses, and it says qualified education expenses. So this is like tuition, paying books, paying fees for yourself, for your child. Like real education costs, not buying somebody a car so they could go to college, not paying for an apartment for somebody in college. I'm talking about actual education expenses. You could pull money out of a traditional IRA for that and avoid the 10% penalty. Also, if you're a first-time home buyer, you can actually take out $10,000, up to $10,000 to go toward the cost of your first-time home. And obviously you want to have a paper trail. You want to be able to show that this is where that $10,000 went. It didn't go to some shoes and a purse. It went to my new home. If you have unreimbursed medical expenses or health insurance premiums that you pay while you were unemployed, you can also take money out for that. If you became totally and permanently disabled, you can pull money out. They're not going to penalize you for doing that. Or if money comes in from a rollover. Actually, that rollover, it shouldn't be on this screen. I'm sorry. That's a whole nother section. Well, actually, let me tell you this. You can move money between IRAs at any age. We call it transferring and rollover. And there's no penalty for doing that. It's not a taxable event. So I think that's probably why I put it on this slide. With the Roth IRA, you also have exceptions. Because the Roth IRA does have the 10% penalty as well if you pull the money out before 59 and a half. Unless you are totally and permanently disabled, or again, also having your first time home purchase up to $10,000, or if you also have those qualified education expenses. So in reality, I typically recommend IRAs to my clients who they come to me and they're like, I want to save money for my first time home, or I know that I'm still in school and I might want to have money for college to pay for tuition. I'm like, open a Roth IRA because you could save and invest money tax-free, and you could still pull it out for these things tax-free as well before even getting to retirement. And if you don't need to pull it out, guess what? You still have money that you're saving for retirement. So a lot of parents and grandparents, sometimes I typically will recommend a Roth IRA, maybe the traditional IRA to them also, to serve as a dual purpose. Like, let's grow the money for the house, but let's grow money for college or whatever. But also we can have money all in one growing for our retirement as well, whatever's left over. So those are the exceptions to avoiding the 10% penalty if you're not 59 and a half when you pull that money out. So that should be pretty straightforward. So with other distributions, if you're age 59 and a half, you can take money for the traditional IRA. Once you hit that age 59 and a half, you can pull all the money out, any money out, it doesn't matter. But whatever you pull out, you will be paying taxes on. You'll pay your ordinary income taxes. So I'm going to go through a couple examples. Just keep in mind that any money, and again, in retirement, when you need it the most, you have to pay taxes. So you take $10,000 out, that $10,000 will be added to, it'll be taxed like you earned it at the job. And you have to pay taxes on that money. Now, when the taxes come out, so there's two things. One, like let's say you requested a distribution from your IRA. At the time that you request it, you can tell the financial institution, hey, take the taxes out and send me whatever's left over. Or you could take the full amount out, but you'll get a tax form from the financial institution, and then they'll say, hey, Shantae took $10,000 out. That's when you have to report that. Remember back on the 1040 right here, it says IRA distributions line 4A. That's where you'll report. If you don't have the taxes taken out at the time you actually get the money, you have to report it here, and it's added to your income for the year. So you're like, oh, I took out $10,000. Let's say you earned $50,000 that year. So that $10,000 is added to your $50,000 normal income. And that's how they pay, it's calculated here. So you pay the taxes. So if you're not 59 and a half and you take the money out, not only will you have that 10% penalty, but you also still pay taxes because that money is growing tax deferred. It hasn't been taxed. Typically, the money's in the Roth traditional IRA. The traditional IRA have not been taxed either. So you're paying the 10% penalty and you're paying taxes. So you really want to be wise. Again, this is not an investment account. If you're thinking you might need to dip into it and you don't qualify for one of those exceptions, this is not the account that you want to be pulling out of early. It really isn't. There's other investment accounts that you can set up for pulling out early. With the traditional IRA, another caveat is that, remember, with the traditional IRA, your taxes are deferred. You don't pay taxes until you pull the money out. But what if you get to a certain age and you're like, I don't really need to take money out my traditional IRA. I really, I don't need it. Maybe you're lucky, you're rich. You don't need the money that you saved. The IRS says, like, look, Shantae, you can't keep deferring taxes now. You're going to have to start pulling money out so we can get our check. This is the IRS talking to you, Uncle Sam. Your uncle's telling you, you're not going to keep not paying me taxes. So you're going to, at 72, I'm going to force you to take money out. They call it required minimum distributions, RMDs. That's when the IRS says, you have to start taking money out. I need my cut. And if you don't take it out, guess what? The money that you should have taken out, I'm going to charge you a 50% penalty. Dang, the IRS is crazy. Tell you, I've seen this happen. I've seen people who are 72, 73. They didn't take their traditional IRA money out, and they were hit with a 50% penalty. So, for example, in your financial institution, so if you're working with a financial advisor or your financial institution, they will let you know, you need to pull some money out because we don't want you to get hit with the RMDs. They'll let you know. They'll say you need to take out $5,000. You need to take out $6,000. They'll actually calculate that for you, and you should take that out. But let's say it's a $5,000 distribution that you have to take, and you don't take it. They will charge you 50% on that $5,000. That's $2,500. So not only will they force you to take out the $5,000, they're actually going to also charge you $2,500 of your money because you did not take your RMDs. Now, I don't know too many people who get to that point because they don't need the money, but this is some serious stuff. You don't want to get to the RMD point. You really don't. So I try to make light of it, but it's for real. You don't want no penalties from the IRS. Trust me. I know a lot of people who owe the IRS. It's not a pretty situation. So with Roth IRAs, another cool feature is that you actually are able to take out any contributions without penalty at any time, as long as the money's there. So for example, myself, I don't want to tell you guys how old I am because you're going to look at me like I'm crazy, but I'm in my 30s, late 30s. And let's say in 2021, I contributed $6,000 to my Roth IRA. And I'm like, you know what? Dang, I need that money. I can actually take out my $6,000. That was what I contributed. I could pull it out. No penalty, no taxes, no nothing. Now, do I really want to do that? No, because I put it there for a reason. I put it there for retirement. But technically, you can take out your contributions at any age, no penalty, no taxes. You could put the money in and take it back out if you need it. Does that make sense? Now, earnings, let's say I put $6,000 in there and I earned $1,000. So now it's $7,000. I can't touch those earnings though. I think that's my next little point. Nope, not yet. I can't touch the extra $1,000. I can only take out what I contributed, what I actually put into the Roth IRA. A quick question that came in. Can you open an IRA to save up for a home? Yes. Up to that $10,000. Yes. You can pull out that $10,000 with a traditional or Roth IRA, and that's one of the exceptions to the rules. However, if it's in the traditional IRA, you will pay taxes. Actually, let me double check that. I know you won't pay, you'll avoid the penalty. Let me double check the taxes part though. I'll double check that. But good question. With the Roth IRA, if you're age 59 and a half, again, that's the magic age, you can take funds out without penalty and you don't pay taxes. That's why everybody loves a Roth IRA, because you can take the money out in retirement and you don't have to pay taxes. That's why Uncle Sam has a lot of limitations on it. They don't want you being rich and putting all this money away and not paying him taxes. So that's why a lot of people tend to gravitate to the Roth IRA, because it grows tax deferred and you can pull it out tax free. So it's really a great way to invest your money. And again, we call it a tax advantageous way to invest your money. One thing to keep in mind though, I was kind of alluding to it earlier though, is that any earnings inside the Roth IRA, so this is where it grows above what you put in, because you got some really great investments, you have some earnings. Now the value of your portfolio has increased in value. That difference cannot be touched for 5 years, no matter how old you are. So again, example, let's say you're 60 years old and for whatever reason you're still contributing to your Roth IRA, and let's say you had earnings, and while you were age 60 it was like $1,000 in earnings. You can't pull out that $1,000 in earnings till you're 65, 5 years later. Even though you're past that 59 and a half requirement, the earnings have to stay in the account for at least 5 years. So when I say you can take your contributions out, yes, that's what you put in. But anything above the contributions that have grown, those are considered earnings. You can't touch those for 5 years. So that's the little rule. It's a little caveat to the Roth IRA, that you have to keep that amount in there. Does that make sense about the earnings? It's one of those little gotchas that the IRS has established when it comes to the Roth IRA. I'm going to let you guys know we're going past the hour. I didn't practice this beforehand. I thought I'd be done in an hour. But if you need to drop off, please do. It won't offend me at all. But again, you'll get the recording and all that. Thank you, Candace, for that confirmation. Now, if you are taking money out of a Roth IRA before 59 and a half, you will also, again, you'll get hit with that 10% penalty and you'll pay taxes. So you actually lose your tax benefits if you pull money out of the Roth IRA before 59 and a half. Unless what? It's an exception. Unless it's for the house, the education, or you became disabled. Otherwise, if you don't qualify for that exception and you pull money out early, you get the 10% penalty and the ordinary income taxes. I think that's it on this slide. Okay, last thing with the Roth IRA, which is really cool, you can leave that money in there as long as you like. So unlike with the traditional IRA, Uncle Sam really doesn't care if you're 72 years old and you're rich and you don't need to pull the money out the Roth IRA. They do not have any RMD requirements on the Roth IRA. So if you don't ever need to really pull it out, you don't have to. Let's say you pass away, whatever that value of that account is, it will transfer onto your beneficiaries. So they'll get the money in the account. I think that's all I have on this screen. Okay, so let's just go through a couple quick examples because there's so many different scenarios. So let's say in this example, you're 51 years old. Last year, you earned $55,000 in income. And you decide to withdraw $10,000 from your traditional IRA to go on vacation. So somebody unmute yourself. Tell me a couple things, right, that you notice about this right away. What rules do we need to look at?
Yes, so you're 51, you're not 59 and a half, so you'll get a 10% penalty because it doesn't qualify for those reasons to withdraw or get distributions before 59 and a half. That vacation doesn't qualify for that.
Yep, perfect. See, Tammy, you can teach the class. I told you. Be like Tammy. Join all my webinars. So thank you, Tammy. So what happens is when you pull that 10,000, the first thing you get hit with that 10% penalty. So right away, $1,000 gone because you hit that 10% penalty. So you have $9,000 that's paid out to you. And remember, I said that you can actually have the taxes taken out when you have the money paid to you, or you can have it added to your income. So in this example, I'm having this added to your income for when you file your tax return. So so you have that $55,000 plus the $9,000. It's like you earned a whole nother paycheck. Now you have to report $64,000 of income to the IRS. And at that income level, you'll be paying a 12% tax rate. It's roughly about $7,680 in taxes. So I wanted to kind of go through that example. Let's go through scenario number 2. In this example, you're 61. In 2021, you earned $55,000 in income. Now, you decide to withdraw $10,000 from a Roth IRA, of which $6,000 you contributed and $4,000 is in earnings. So somebody else besides Tammy unmute themselves and tell me about this scenario.
I'll take a stab at it. The $4,000 you're taking in earnings has to have been at least 5 years old. Okay.
Yep. Anything else you notice about this particular example? What about the age? So if you're 61, it means you're past the 59 and a half age requirement. So that means no penalty, right? And no taxes. Because you're only actually going to take the $6,000. Like you said, Christopher, only $4,000 that has to stay in there. I actually didn't indicate if it was in there 5 years, but we're assuming that it hasn't been. So actually only $6,000 in this scenario will be paid to you if you really want to avoid all the taxes. And there's no penalty, of course, because you're 61. You report your $55,000 income to the IRS, and that's the only thing that has to be taxed is your regular income, which is only $6,600 in taxes. So wanted to just kind of give a couple different examples just so that you start thinking about pulling money out and just different scenarios. Go ahead, Christopher, unmute yourself. What's your question?
Yeah, I have to drop off, and thank you very much. I just wanted to, before I go, thank you. I did things a little backwards. I separated some money out into a Roth recently and attended the webinar to learn, was that a good thing to do or not? You don't know what your taxes are going to be in the future, blah, blah, blah. But thank you very much for your comment at the beginning that you really ought to diversify it to all three. So I feel comfortable having some money going to a Roth now, even though I would hope my taxes will be lower in the future, not higher, but you never know. So thank you very much for that.
You're welcome, Christopher. And actually, I'll time point this video for you because I'm going to talk about when you transition to a Roth IRA, the benefits and what happens. So basically, there's no tax hit. I'm sorry, you pay taxes now. It depends on where you took the money from.
Sure.
But it did. Basically, you took the tax hit now. Like, let's say it came from a traditional IRA, but moving forward, no taxes. So great move. Great move.
Okay. Yeah, and I'll watch out for the recording link and check out the rest of it later. Thank you.
Oh, you're welcome. Enjoy the rest of your night. So we'll move on. And this is actually IRA rollovers. So money's coming into the IRAs, because I actually didn't talk about it fully. I want to address it now. I realize now I didn't actually write it on the slide. So where does money come from to put into these IRAs? Because one of the questions that was coming up earlier was, pre-tax money out of my paycheck. No, these accounts are open separate. So if you open a traditional IRA, actually I might talk about it on this slide. Let's see. Yes. Okay. I did kind of talk about it. Okay. So if you were to open a traditional IRA, generally you would do this because you're transferring money from another account in that tax later bucket. And let me see. Actually, I do have this slide up. I'm going to show it to you real quickly. So remember how I was showing you, we're talking about, monies in the tax later bucket where the traditional IRA is. You can actually move money from any account in this tax later bucket into a traditional IRA because they all have the same tax consequences. They are all taxed the same way. So typically most people, when they open the traditional IRA, they're taking money out of their 401k. Maybe they're taking money out of their deferred comp plan. Maybe a SEP IRA, maybe an annuity. So typically when you're putting money in a traditional IRA, it's coming from another tax later account. That's the best way to leverage a traditional IRA. So that's why I said it'll come from a 401k, a 403b, all these other things. And that's what we call a rollover. You're rolling it over from a 401k to the traditional IRA. You're transferring, because you could transfer from one traditional IRA to another traditional IRA. So we're transferring the monies directly in. And so when you do that, so typically these accounts listed here, the workplace retirement accounts in particular, those monies have never been taxed. When you have a 401k, that money goes in before taxes. So when you move it to a traditional IRA, it still maintains, it's never been taxed. It grows tax deferred, but we know when you pull it out is when you pay your taxes. Let's say you have a workplace retirement account or, another traditional IRA, and you don't move it directly over. You don't move it directly into another traditional IRA, and you have that money sent to you. We already know if you're not 59 and a half, and actually, let me go back to this screen here. All of these accounts have that 59 and a half requirement, except the pension, because the company employer would determine that. But typically, all of these other ones have that 59 and a half requirement of pulling money out and you're taxed. You pay your taxes. But when you, we learned earlier, if we pull that money out before 59 and a half, we get hit with penalties. We get hit with taxes. And let's say you were to do that. You instead of having it transferred directly over to another traditional IRA or another financial institution, you had that money paid to you. They wrote a check payable to Shantae Moore. You actually have 60 days to take that money, every dollar, and send it to a traditional IRA to avoid the tax consequences of that transaction. So let's say I had $100,000 in my 401k. I quit the job. I was like, cash me out. I want my $100,000. They give you a check for $100,000. You can hold on to that money in your bank account for 60 days and transfer it to a traditional IRA. And you won't get hit with the taxes because of making that transaction. So it's a 60-day window to move it between accounts. If you don't move it directly to the other account and it comes to you, you have 60 days to get it into another traditional IRA. Does that make sense? Try to make that clear. With the Roth IRA, typically the monies that you put in are coming from a Roth 401k. If your job offers that, you can transfer that out to a Roth IRA, or coming from another Roth IRA can go in. But otherwise, one thing I didn't mention on the Roth IRA, otherwise it's just coming out of your pocket. Most folks, when they establish a Roth IRA, again, this is not tied to a job. So this is coming out of money that you earn. So you're like, you know what? I'm going to take $1,000 and put it into a Roth IRA. I'm going to contribute wherever your money came from. Typically, it was already taxed, and whatever money you put in, moving forward, it won't be taxed in the future. Which that's what I failed to put on this screen. Or you could also do a conversion Because let's say you establish a traditional IRA and you're like, man, I wish I did the Roth. I didn't know it had all those tax benefits. You can actually also move money from a traditional IRA and convert it to a Roth IRA. I didn't pre-print my slides, so I don't know how much I went into detail on this. So basically what that happens, as I was explaining to Christopher earlier, is let's say you establish your traditional IRA, and remember, typically because of where that money came from, it probably never been taxed. You can't take money directly from a traditional IRA to the Roth because the IRS is like, hold on now, I need to tax the money in that traditional IRA first. You're not just going to keep it tax deferred and put it in another tax never place. So what happens is you take the tax hit. Let's say you had $100,000 in your traditional IRA. You'll pay taxes on that $100,000 at whatever your income tax rates are. And whatever's left over will go into the Roth IRA. And then that remaining amount will invest. It'll grow without paying taxes. And again, you get the tax benefits of withdrawing it in the future without paying taxes. So that's if you're moving it from a traditional, it's called a conversion. We're doing a Roth conversion. Oh, that's what that's called. And then once it's in the Roth, moving forward, it's growing tax-free and you get to pull it out tax-free. Let's move on. I'm actually almost done. So as I kind of finish this, don't log off yet. If you can stay on, hold on with me. Which one should you invest into? It always depends. I think I put the slide on a couple of my presentations. It really does depend, where's the money coming from? Because if it's coming from, again, that, tax later account, 401k, somewhere else, then you have to go to a traditional IRA first. And then you can convert to the Roth if you want. But that depends. If the money's coming out of your pocket, then you would probably do a Roth IRA. Again, how much money do you and your spouse earn? So if you're worried about income, if you're worried about making too much money, at some point the Roth IRA, you won't even be able to contribute to it because you earn too much. And then you can only do the traditional IRA. So that's dependent upon what you file at tax time. And then again, do you need access to this money? Because it's long term, it's for retirement. I don't want you establishing any IRA thinking I need to pull money out in a year. Even with the Roth IRA, even though you can take out your contributions, you really want to be in a position where you don't have to do that. You can do it, but you don't really want to. You really want this money to stay there and grow for your retirement. And then think about, when are you going to pay taxes? As you notice, our favorite uncle, it makes a big difference. Do we pay taxes now? And I put everything else in a Roth IRA and I don't have to worry about it. With workplace retirement accounts, when you're transferring that type of money, unfortunately, it's one thing you really can't avoid. You will be paying taxes at some point. But that's something you really just got to factor in. And your age. I know how old I am. I don't know what tax rates will be 30 years from now. They might jump up, they might jump down. Those things change. That's the scary part about it. That's the scary part about all these retirement accounts. We don't know what the tax rates will be when I decide to retire and pull money out. So just as a quick recap of some of the things that we talked about. If you have any questions, I know, Tam, you keep unmuting yourself. You got a question?
No, go ahead.
Okay. These are kind of like the major recaps. So question, is there an age limit on when I can open and contribute to an IRA? No, you can be any age as long as you have that taxable income. If I earn more than $6,000 in 2021 or $7,000 if I was over 50, is there a limit on how much I can contribute? Yes, we know for any IRA, you can only contribute $6,000 combined total, or up to $7,000 if you're age 50 or older. For the traditional IRA, it doesn't matter what your income limit is, you can still contribute it. But with the Roth IRA, we know that the income matters. If you make too much, you eventually can't contribute to a Roth IRA. And then the main thing about the deductions, because that's a big important part, is that the traditional IRA, we know that we can take the deductions, and with the Roth IRA, no deductions. So that's my slides. Any questions? Let me take a couple questions. Feel free to unmute or put it in chat. So we had a question, can you convert a non-Roth 401k to a Roth IRA? So that'll just be a regular 401k. No, it has to go from, here, let me reshare this slide. And it's okay, don't worry if you just joined and missed it. If you have a 401k, you have to put it into a traditional IRA first and then convert it to the Roth IRA. So when you're moving your money from a 401k, you're basically getting it out the hands of the employer. You're taking control over it. Thanks, employer, I don't need your help no more. I'm going to take control over it. So you move it to a traditional IRA first that you open and establish. Sorry, I don't know where my cursor is. It's acting funny. You open it to the traditional IRA first. Oops. Oh, Lord, what did I do? Sorry. And then you convert it to the Roth IRA. So really good question. Does that answer your question, Candace? Okay, good. Okay, go ahead, Tammy.
Oh, I was going to say, is that the same for the deferred comp plan?
Mm-hmm. Yep.
Okay.
Yep. Anything in those tax later positions, you have to move it. Because you're just taking it from the employer into your hands, and then you can do whatever you want with it. You can cash it out, you can reinvest it. But if you want to do the conversion, they won't let you move it directly into the Roth. So move it to the traditional IRA first and then to the Roth. That's a good question. I didn't think to put that in there.